Tom Lee, the head of research and chief investment officer at Fundstrat Capital, says 2026 could still be a double-digit year, and in this video we are going to break down exactly what he means and what it could mean for your portfolio. Tom Lee joined CNBC's Closing Bell to talk about the 2026 market outlook, why we could see real volatility ahead, and what investors should be paying attention to when it comes to stocks, earnings, and positioning, in a market that has already delivered strong returns for multiple years. The big question is whether the bull cycle is running out of steam or whether it still has room to extend. In a moment, I am going to play the clip of Tom Lee on CNBC. Right after you watch it, I will come back and give you my reaction and breakdown of the key points he made, what I agree with, what I think investors are missing, and how I would think about risk going into 2026. Then, I am going to take it a step further and share my in-depth analysis of 3 tech stocks that I believe you can buy and hold long-term, with the kind of fundamentals that can stand up through volatility and still compound over time. Hit the like button, share it with a friend, and let me know your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now, let's hear what Tom Lee has to say.
All right, Tom. So, 2023, we turned in 24%. 2024, we turned in 23%. Pretty good this year, too, 17%. Next year, we fill in the blank with what sounds reasonable to you.
I think it's still possible to have a double-digit year. There have been 12 times in the last 100 years where markets posted 3 years at 20% gains. This year hasn't finished yet. Globally, half of the time, markets do even better in the following year. So I think next year is a year where the debate's going to be, is the bull cycle over or is it going to extend? I think it's going to create quite a lot of volatility in the first half, but I think GDP growth stronger. We have a dovish Fed. Valuations are reasonable, so I think we end up exiting very strong.
Why a lot of volatility in the first half then?
Part of it is the Trump tariffs could get overturned. There is a possibility of an extended government shutdown. The nomination and then confirmation of a new Fed chair is going to take 3 months. That could be very controversial. I think all of that happens in the first half of next year.
How's that sound to you, Steph?
I think that sounds really great. The economy is on solid footing. We've been talking about that all year long. Last week, we got some really encouraging data with regards to weekly jobless claims. Inflation came in a little bit better. We've talked about the H8 Federal Reserve loan growth, lending. That's actually at a 9-week high, all-time high for loan growth. That's very bullish for activity overall. The industrial metals are at all-time highs. And you have global central bankers, including the Fed, getting more and more closer to the neutral rate. That's a good thing. And Fed cuts take a while. There's a lag impact, and I think that's going to bode well for next year. And then you have the one big, beautiful bill. $150 to $175 billion going into the consumer's hands, going into corporate America, so capex continues. You add it all up, and I think you have double-digit earnings growth. There are some numbers out there that are a little high, like 16, 17% in earnings growth. I'm not there, but I do think you're going to see low teens.
Mr. Harvey.
I think high single digits is reasonable.
Single.
I can't get to 10%, 12%, 15 just yet. Right. One of the things that Tom said, I agree with wholeheartedly. The first half, you're going to see a lot more volatility than you have seen in a while. I think people are sleeping on the macro risks, be it USMCA, be it the transition with the Fed. If you listen to Powell, now he wasn't cocky about this. He was very humble. But basically what he said is, I'll see you at the book signing. We have growth higher. We have inflation lower. We're back to neutral. We don't need to do anything from here. And 6 months, if you don't cut rates for another 6 months, that's an eternity in the financial markets. And then the last thing is, I think corporations are going to, after a good year this year, they're going to manage down expectations. As you manage down expectations, that puts a little volatility to the marketplace. And lastly, risk is priced very, very expensively, either in the equity markets or the credit markets. It doesn't take much to upset the apple cart.
You want to respond to that? Because it seems like if not a step-by-step counter in some respects to your view, it certainly is enough of one. I mean, there's going to be more volatility. We're underestimating, maybe too complacent about macro risks. that are out there, among other things. What do you say?
I mean, I feel good about the macro environment, all the things I just said. And I think it is a consumer that has been resilient. We've been talking about the consumer forever, how they have hung in there. Yes, it's the high end, not the low end. That tends to be the case on a regular basis, unfortunately. I don't think the AI infrastructure capex cycle is going to change in 2026, and that's fueling about 3/4 of the GDP growth. And I do think that we always have a wall of worry. And I've said it, you've heard me say it, Scott, I worry when I don't worry, because that means that we're complacent. I think there's a lot that people have on their minds. I think we're going to be able to get through it, because fundamentals at the end of the day, they run the show. And if you do have an economy that grows 2.5%, 3%, well, we're growing north of that now. But if you have an economy that's growing 2.5%, 3%, typically that's been a 10% earnings growth. And I think we're going to be a little bit more. And you have lower interest rates. By the way, you have lower gasoline prices. You have lower egg prices.
But address the valuation issue that stocks are. You want to go there?
Well, it's all about earnings, though. It's if I think if earnings are growing in double digits, then I do think the valuations are very attractive, especially in other sectors beyond tech.
Yeah, and we have to keep in mind the equal weight S&P 500 PE is 17 times. It's lower than it was 5 years ago. So the market actually has derated in the last 5 years because of these black swans of the shutdown, inflation surge, fastest Fed hikes in history, et cetera. So actually the equal weighted market is cheaper. I don't think risk is actually that expensive.
Listen, so let's turn it to small caps for a second, just talk about risk. There's two indices for small caps, Russell 2000, S&P 600. Both small cap, they should perform pretty much in line with each other. Russell 2000 is outperforming by 8% this year. Russell 2000 outperforming by 8% because S&P 600 is a high quality index. The things that don't earn money, the things that have excessive beta, all really driving that marketplace. So I see, if you look at IG credit spreads, less than 80 basis points. If you don't know that market, that is tight, right? If you look at the S&P high beta index, it's up 35%, 34, 35%, double of what the S&P is. I see a lot of froth, right? There's a price for risk. It's here. I think the price for risk is down here.
Interesting. I mean, it is one of the key questions, no doubt, is whether the broadening story that we've been talking about has legs. And what do you need to reach some of the loftiest targets from strategists that are out there? I mean, the top one's 8,100. Dom Chu joins us now. I mean, it's a nice range, Dom.
It's a big
81's the top, as you show right there.
Yeah, that's right. 81's the top. That's John Stoltzfus over at Oppenheimer right now. So that implies a pretty decent-sized gain. And the lowest is still bullish, only about maybe 4 or 5% higher than current levels right now. But that's 𝗣𝗟𝗑 Subramanian over at Bank of America. So 7,100 is the low end of the 15 strategists that we've surveyed here at CNBC. 8,100 is the high end. The middle, 76.29, actually implies upside of just about 10% or so from the current levels that we're at right now. So generally speaking, we could get to, if we get to the average target price, a double-digit gain for the S&P 500 by the end of next year. As for whether or not we can see the contributors for that move higher, yes, it's always been about Mag 7, but these days we're seeing a little bit more relative strength in other parts of the market that imply maybe a broadening out trade. Check out the small cap ETF, which is already up 21% on a year-to-date basis. The mid caps are up about 11.5%. Underperforming, though, the S&P 500 at 15. So the small caps getting some legs and some steam that could bode well for the broadening out trade. As for the sectors that could be interesting here as well, check some of these out. Because over the last 3 months, it has been healthcare, financials, and industrials that have been among the star performers on a 3-month basis. So do they carry some relative strength or momentum over the last 3 months into the early part of 2026? That's going to be key as well. As for some of the individual industries that are leading the way higher, speaking of the broadening out trade, the XME is the Spider Metals and Mining ETF. That's already up about 89% so far just this year. The ITA is Aerospace and Defense, which is 51% higher. And the NASDAQ Biotech ETF has been a standout, up 30% so far. So as we talk about the broadening out trade, some of the best performing industries and ETFs out there that track them are not tech or comm services related. There are other parts of the market, so that's going to be a real key for that trade in 2026, Scott. And by the way, for more on that story, just head over to cnbc.com/pro. Subscribers get all the context and detail around those big calls out there. I'll send things back over to you, Scott.
Yeah, that was great stuff, Dom. I appreciate you for that. That's Dominic Chu. So you've already had a good amount of broadening. The idea that the market hasn't been broad is a fallacy, really.
I mean, yes and no, because when you look at 3-year stacked, it's still Mag 7. And so I think it makes sense to not just look at 2025 by itself, but how have stocks done since the end of 2022. To me, there's a lot of room for cyclicals to really outperform, including financials, because the ISM's been below 50 now for almost 3 years. That hopefully turns up above 50 next year, and we get a pretty, I think, what I consider a cyclical broadening of the market.
To outperform tech?
Yes, and Steph and I were talking about this, that I think tech earnings visibility is still good, but the multiple expansion story doesn't have as much upside as industrials or financials or energy or even basic materials.
It's funny because you just bought more Meta.
I did.
Like this morning or yesterday, right?
This morning, yeah. I still like it very much. It's still down 6% from its highs. I still think that they win from AI and what it's going to mean for their ad business and for their messaging business and customer apps business. The metaverse cost cuts are $5 billion in savings annualized. Gives them $2 a share, again, annualized in earnings. I think this company can actually deliver $36 to $38 a share by 2027. That puts this thing at 18 times earnings, and it's growing earnings at 20% and revenues at 26%. All that being said, so it's a big position, top 5. All that being said, I am underweight other mags. I really only own Amazon, very small Microsoft, but I do think that financials are going to be the sector leader next year because we're not pricing in, on a valuation point of view, we are not pricing in all the deregulation that is going to come and the excess capital that is going to be returned to shareholders and, by the way, lead to loan growth, which is why I look at the H8 data. It's really important to see what banks are doing. If the banks are lending, that's going to help the entire economy as a whole us grow, and these stocks are not expensive. Capital One is at a 12 times multiple. You know, even Morgan Stanley, expensive, right? 17 times. Bank of America, 1.4 times book. I think that there's a lot of runway left to the financials, and that's the sector that I've been overweight for a long time, and I continue to be.
You agree with that?
We like parts of the financial. We really liked the financials about a year and a half ago. Now we're just being a little bit more selective. I agree with some of the broker-dealers, some of the credit card companies, relatively cheap. I think there's some upside.
But not the big banks?
Big banks are fine. I just don't think they're an overweight at this point in time. Right? They performed exceptionally well. Actually, JP Morgan's outperformed a big section of tech over the last 3 and 5 years. So it's performed, right?
But why wouldn't you be overweight that group? I mean, if you think that earnings are going to stay strong, the economy is going to be good, you're going to get more deals, you're going to get more IPOs, all of that, deregulation and everything. Yep. That feels reasonable to expect all of that.
It's reasonable. I think a lot of it's in the price. I think they need to either pull back or consolidate. And if they do either one of those, we'll take a look at them. But I agree with Stephanie. The deregulation story has more to play. But in the banks, I just don't think it's the right time to do it. They perform so well. Valuation is fine. The underlying fundamentals is fine. But there's nothing undiscovered there where we're saying, got to own the banks.
But we haven't had a net interest income cycle in about 10 years. And the steep yield curve will be very beneficial for that.
Yeah, but I thought you talked about yields coming down.
We're seeing a steepening in the yield curve.
I know we are now. But I mean,
that's very positive.
Well, because the front end of the curve's coming down because on expectations of rate cuts.
That's okay. I mean, rates are coming down on the short end. Probably 10 years kind of sits here. Maybe it goes down a little bit. But I still think you're going to see a steepening yield curve. And that will help a big part of the bank's earnings, which is almost 50 to 60% in some big banks' cases. That's their revenue generation. So I think earnings estimates are going much higher, and that's why I want to be overweight.
All right. Well, yeah, you got some.
I was just saying, just to add to Stephanie's point, I think tech-forward banks that are using AI also are big margin stories because employee compensation is their biggest expense. I think banks are going to look more like tech stocks in the future, where they use AI to reduce employee dependency. And earn the same money and their multiples go up.
All right, well, speaking of AI, one of the critical questions is, can we get past all the bubble banter talk? Well, bubble banter, really. Kind of redundant if you say banter talk. 𝗣𝗟𝗏𝗧 𝗖𝗢𝗗𝗘 joins us now with that critical question, because we're obsessed with it now. I wonder what early 26 is going to bring.
We're probably going to be obsessed with it for some time, right, Scott? I mean, the AI trade, for now at least, in the last few days, back on its feet, but none of the big questions actually went anywhere. This data from SimilarWeb, it gets at one of the most important questions in the whole trade, OpenAI versus the Google AI universe, not just on models, but across the stack and what each one represents. Now, from January to November of this year, OpenAI gave up a little bit of market share. Google, though, grew its market share from about 6% to 15%. This suggests that Google has the momentum and is finally converting distribution into real gains. Now, it's also quietly challenging NVIDIA on the hardware side with its custom AI chips known as TPUs, and that could impact the entire cost structure, what we know of it today in the AI trade. Now, going into next year, there will continue to be questions around whether OpenAI can meet its own ambitions and obligations while competing with an incumbent, Google, that controls the entire pipeline. Something else I want to mention, Scott, there's this really interesting debate going on at the very highest levels of AI right now. It's playing out on X between DeepMind's Demis Hassabis at Google and Yann LeCun, who just left Meta. These are two of the most prestigious people in AI. Hassabis is arguing that today's scaled models, they're already on a credible path to general AI, while LeCun is saying the current approach is a dead end without a new architecture. So if Hassabis is right, scale, chips, infrastructure, those things keep winning. But if LeCun is right, a lot of today's capex is going to look premature, and the payoff gets pushed out. And that is really the central question on the bubble, right? Can we justify all of this spending?
Yeah, and maybe we don't know the answer for a while. Dee, thank you. 𝗣𝗟𝗏𝗧, Chris, you say that the tech bubble does not pass our litmus test.
Yeah.
Explain.
So again, it gets back to something like JP Morgan banks, which is outperforming. Go back to late 90s, and the banks really underperform. Here, the banks are actually leading the way. Multiples that we're seeing, still not excessively high. You go back to late 90s, whether it's Oracle or Cisco, you're not seeing it. More importantly, let's go to, can you fund these risky endeavors? If you go to the credit markets, anything not named Oracle, you can go out and you can still fund. And so this market is still rather healthy. Valuations are not high enough at this level. We don't see the frothiness that we saw back then. And the commercial aspect is so much better now than it was in the late 90s.
So you think the Oracle situation or issue or whatever is idiosyncratic to itself?
That's what the market's telling you. The market's telling you that Oracle is very idiosyncratic. If you look at the credit spreads, if they came to the market, you'd be questioning how much can you bring to the market, at what spreads. If anything else, any of the other hyperscalers came to the market would probably not really think about it and digest more or less anything that they brought to the market.
You think we continue to have dispersion among these stocks? Yes, Alphabet is up 63% year to date. NVIDIA is up 37%. Microsoft is an underperformer slightly to the market, as is Meta, as is Apple, as is Amazon. Does this continue?
Scott, I'm going to say something that's not very popular, but I still think they trade as a basket because they do all have linkages to the same theme, but at different points of time, some will lead versus the others. And so I have clients that do mean reversion among the Mag 7, but I think that they're largely one complex.
Okay.
I hope we get mean reversion in the names that I own, because Meta obviously has a ways to go, but Amazon does too. Out of all the Mag 7s, that one to me has been the most surprising, that it just can't get out of its own way.
Do you agree with what he said, though, that you're going to get back to trading like a group? Because the stocks would suggest otherwise.
Yeah. No, I actually think that at any given point, you have a couple of leaders and a couple of laggards. And I think I'm betting on that the fundamentals are strong enough in the laggards that they will mean revert next year. That doesn't mean that Alphabet is going to fall 50%, but maybe it just trails for a little. Maybe it takes a pause. Same thing with Broadcom. As you know, I've said that before, that maybe it just takes a pause because it has crushed NVIDIA over the last year. And that's okay, but the fundamentals are still very, very strong, sound. Estimates are going higher. And when estimates go higher, no matter if these stocks take a pause, eventually the stock prices catch up with the earnings revisions.
Last point to you. How will these trade?
We like the software space. We think it's more selective. It's not over. and we think the best risk reward is in the software space.
All right, guys.
The panel started by anchoring everyone in the reality that the last few years have been unusually strong. You have back-to-back years with big gains, and then another solid year on top of that. That is important because when markets deliver a streak like that, it changes investor psychology. People stop asking, can this continue? And they start asking, when does it break? Tom Lee's first move is to calmly say, it can continue. And not just continue, but still deliver a double-digit year. He supports that by pointing out something that sounds simple but carries a big implication. In the last century, it has happened a dozen times where markets posted 3 years of 20% gains, and in global markets, about half the time, the year after that was even better. The hidden message is this: strong years do not automatically use up future returns. Momentum and macro conditions can carry forward longer than most people expect. But Tom does not pretend it will be smooth. He basically frames 2026 as a year where the entire market narrative becomes a debate. Is the bull cycle over, or is it extending? That kind of debate is exactly what creates volatility, because every piece of data gets interpreted as proof of one side or the other, and then he lays out why he expects the first half to be the choppy part. He lists political and policy landmines that could hit early. Tariffs tied to Trump policy could get challenged or overturned. There is a possibility of an extended government shutdown, and then there is the very sensitive process of nominating and confirming a new Fed chair, which he says could take about 3 months and be controversial. If you translate that into market language, he is describing headline risk and uncertainty risk. Even if the economy is fine, markets hate uncertainty because it disrupts forecasting. Here is what is interesting, though. Tom immediately balances the volatility forecast with the core bullish engine. He says GDP growth should be stronger, the Fed is dovish, and valuations are reasonable. That combination is basically his thesis. If the economy keeps growing and the Fed is not actively trying to slow it down, then earnings can keep rising, and the market can absorb a lot of political noise. In other words, he is saying fundamentals can overpower the drama, but the drama still matters for the path you take to get there. Stephanie Link comes in and reinforces the optimistic macro view, but in a more granular way. She points to encouraging jobless claims data, inflation that came in a little better, and she emphasizes lending and loan growth using the Fed's H8 data. Her point is that if banks are lending more, that tends to signal economic activity is expanding, because credit is oxygen for consumers and businesses. She also mentions industrial metals at all-time highs, which is another way of saying real economy demand is healthy. Then she brings in a rate framework that matters for 2026. She says central bankers, including the Fed, are getting closer to the neutral rate. Neutral rate is basically the level where policy is not restrictive and not stimulative. If the Fed is moving toward neutral, that usually means less headwind for growth. She also reminds everyone that Fed cuts have a lag effect. The market reacts instantly, but the economy feels it over time, so she is implying that some of the easing that started earlier can still be working its way through the system in 2026. Then she adds a fiscal catalyst, describing a bill that could put roughly $150 to $175 billion into consumers' hands and into corporate America. Whether you take that number literally or as an estimate, the point is that she believes fiscal support plus easier monetary conditions can keep capex going, and that leads to her earnings view. She thinks double-digit earnings growth is plausible, maybe low teens. She pushes back on the very high estimates like 16 to 17% earnings growth, but she still lands in a bullish range. Now Chris Harvey is the one who brings a different kind of realism. He says high single digits is reasonable and admits he cannot quite get to 10 to 15% yet. That is not necessarily bearish, but it is a warning about expectations. His bigger point is that people may be sleeping on macro risk, and he agrees with Tom that the first half could be more volatile than we have seen in a while. He references issues like USMCA uncertainty and the Fed transition. Then he interprets Powell's posture as basically saying, growth is higher, inflation is lower, we are near neutral, we do not need to do anything. And Chris makes a key market point that a lot of newer investors miss. 6 months without cuts can feel like an eternity in financial markets, because markets are constantly repricing probabilities. If the market is leaning heavily on cuts are coming soon, and they do not come soon, it can create turbulence even if the economy is okay. Chris also brings up corporate behavior. After a good year, companies often manage down expectations. That guidance game can inject volatility, because valuations depend not just on current earnings, but on confidence in future earnings. And then he uses a phrase that summarizes his concern. Risk is priced very expensively. That means investors are paying a high price for risky assets, whether in equities or credit, and when risk is expensive, it does not take much to tip the market into a sell-off. This is where the conversation becomes really useful for us as investors, because it turns into a debate about what expensive actually means. Tom's counter is basically that valuations are not crazy if earnings are growing in double digits. He also says the equal weight S&P 500 trades around 17 times earnings and is actually lower than it was 5 years ago. That is an important detail because most people only look at the headline index, which is dominated by the largest companies. Equal weight strips out some of that concentration and tells you how the average stock is valued. Tom's argument is that the market, in a sense, has been derated by the shocks of the last 5 years, shutdown fears, inflation surge, aggressive hiking cycles. So he is saying, the market already paid a penalty, and that penalty created room for future returns if earnings stay strong. Chris then takes the risk argument into small caps to show where froth might be hiding. He says the Russell 2000 is outperforming the S&P 600 by a meaningful margin, and he frames the S&P 600 as higher quality. In his view, the Russell's outperformance is driven by the lower quality, non-earning, higher beta names. That matters because it suggests speculative behavior. He adds another indicator from credit. Investment-grade spreads under 80 basis points are extremely tight, meaning credit investors are not demanding much compensation for risk. Tight spreads often signal confidence, but they can also signal complacency. Then he points to high beta equities being up roughly mid-30s, about double the S&P. His message is that some parts of the market are pricing risk, as if nothing can go wrong. Then Dominic Chu brings in the strategist targets, which is basically the market's official scoreboard for 2026 expectations. The range they show is still bullish. The low-end target is around 7,100, the high-end around 8,100, and the average implies something like a 10% upside from current levels. The bigger value of Dom's segment is not the exact targets, it is what he uses as evidence for how the market could get there. He talks about broadening, meaning leadership spreading beyond the mega caps. He points out small caps up strongly, mid caps up, and highlights that over the last 3 months sectors like healthcare, financials, and industrials have been among the star performers. Then he calls out industry ETFs that are not tech, like metals and mining, aerospace and defense, and biotech, with very strong performance. That is the broadening narrative in concrete form. It is showing you that capital has already been moving into other areas, at least in bursts. After that, Tom makes a subtle but critical analytical point. He says you should not just look at 1 year in isolation, you should look at stacked performance since the end of 2022, and that view still makes it look like the mega caps dominate. So he is basically saying yes, broadening exists, but it has not fully expressed itself yet in a multi-year way. That is why he thinks there is room for cyclicals, like financials, to outperform. He ties that to the ISM being below 50 for almost 3 years, which signals contraction in manufacturing. If ISM turns up above 50, that often coincides with a cyclical upswing, and cyclicals tend to lead. Then there is a key tactical implication Tom hints at. He says tech earnings visibility is still good, but the multiple expansion story has less upside than sectors like industrials, financials, energy, and basic materials. That is an important distinction. A stock can rise from 2 things, earnings growth and multiple expansion. If tech has already had a big multiple expansion, future returns might depend more on delivering earnings. Meanwhile, other sectors might have both earnings potential and multiple room. Stephanie then gives a very real example of how professionals think about individual megacaps while still supporting a rotation thesis. She says she bought more Meta recently. She lays out why, saying Meta benefits from AI through advertising, messaging, and customer applications, and she cites cost cuts in the metaverse segment that could add meaningful earnings power. She even gives a future earnings framework, describing a scenario where the company could deliver mid to high 30s in earnings per share by 2027. Which would make the valuation look attractive relative to growth. But then she makes the portfolio level point. She is underweight other megacaps and believes financials can lead next year. Her case for financials is all about what is not priced in. She believes deregulation and excess capital return will be catalysts. More capital returns can mean buybacks and dividends, which directly support shareholder returns. She also connects it back to lending growth and the broader economy. If banks lend more, businesses invest more, consumers spend more, and the economy can sustain growth. She also grounds it in valuation examples, basically saying parts of the sector are not expensive relative to their earnings power or book value. Chris agrees on parts of financials but stays selective. He likes some broker-dealers and credit card companies as relatively cheap, but he does not want to chase big banks after a strong run. His reasoning is simple and disciplined. A lot of the good news is already in the price. If they pull back or consolidate, then you look again. This is a classic professional framework. Great fundamentals do not automatically mean great entry points. Then comes a really important yield curve conversation. Stephanie argues, we have not had a net interest income cycle in about a decade. and a steepening yield curve would be beneficial. When the curve steepens, banks can potentially earn more from lending relative to what they pay on deposits and short-term funding. She clarifies that steepening can happen even if the front end falls because rate cuts bring short rates down while longer rates do not fall as much. That spread can support bank earnings, and she suggests that earnings estimates could move higher, which is why she wants to be overweight. Tom then adds an AI twist to the financials thesis that I think is one of the most forward-looking comments in the whole interview. He says banks that use AI could become major margin stories because employee compensation is their biggest expense. If AI reduces the need for labor while maintaining revenue, margins expand, profitability rises, and multiples could re-rate upward. In other words, he is saying banks could start to behave more like tech and how investors value them. Then the panel pivots into the AI bubble question, and this part is critical because it links back to the earlier point about AI infrastructure capex driving a big portion of GDP growth. The segment raises a competitive framework between OpenAI and Google, including market share movement in the AI model ecosystem and the idea that Google is converting distribution into real gains. It also mentions Google's custom AI chips, TPUs, as a potential challenge to NVIDIA's hardware dominance, which matters because hardware economics shape the cost structure of the entire AI trade. But the deepest point is the philosophical debate within AI itself, where one camp argues that scaling current models is a credible path toward general AI, and another camp argues current approaches hit a wall without new architecture. That debate is not academic. It is directly tied to whether the massive capex cycle is justified now, or whether the payoff is further out. If scaling is the path, then chips, data centers, and infrastructure spending remain central. If a new architecture is required, a lot of today's spending could look early, and the market may need to reprice timelines and winners. Chris Harvey then argues that the tech bubble does not pass their litmus test, and says, you are not seeing the same excesses in multiples. He also points to the health of credit markets, basically saying capital is still available, and the commercial aspect of today's tech is stronger than it was back then. That is an important counterpoint to the bubble narrative. A bubble is not just high prices. It is usually high prices disconnected from cash flows, shaky funding, and irrational expectations. He is implying today is different because these businesses have real cash flow power and the funding environment is still functional. They also discuss Oracle as an idiosyncratic case in credit, meaning the market is treating its situation as company-specific rather than a systemic warning sign. That matters because investors sometimes look for one weak signal and assume it means the whole structure is about to collapse. Chris is saying, credit markets are not broadly sending that message. Finally, they return to the Mag 7 dispersion question. Alphabet up huge, NVIDIA up big, while others like Microsoft, Meta, Apple, and Amazon lag at times. Chris says something unpopular but often true. They still trade like a basket because they are tied to one theme, but leadership rotates within the basket. Some clients do mean reversion strategies within the group. Stephanie agrees in practice, saying at any given time, you get leaders and laggards, and she is betting the fundamentals in the laggards are strong enough to mean revert next year. She makes a key point that is easy to miss. Even if stock prices pause, when estimates keep rising, eventually prices catch up to earnings revisions. That is basically a reminder to focus on forward earnings power rather than daily noise. And then, almost quietly, Chris ends with what I think is a useful positioning takeaway. They like software, but it is selective, and they see the best risk-reward there. That suggests a view that not all AI winners are hardware or hyperscalers. Some of the more attractive opportunities might be in software businesses that can monetize AI without carrying the full capex burden. So if I had to translate this entire interview into a practical takeaway for 2026, it is this. Tom Lee is not predicting a straight lineup. He is predicting a year where the first half is noisy, driven by politics, policy uncertainty, and Fed transition drama. But the underlying economic and earnings backdrop remains strong enough to support another solid year. The panel's disagreement is not about whether the economy collapses. It is about whether the market has priced risk too tightly, and whether returns are more like high single digits or comfortably double digits. And the portfolio chessboard they are laying out is not simply buy tech, it is more nuanced. It is about whether leadership broadens into cyclicals and financials, how small caps behave when you separate quality from speculation, how credit spreads and risk appetite evolve, how the yield curve impacts bank earnings, and whether the AI capex cycle keeps validating itself through real productivity and real monetization. If you understand those moving parts, then you can watch 2026 unfold with a clearer lens, because you will know which signals matter, which signals are just headline noise, and where the market is actually placing its bets. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 tech stocks to buy and hold for the long term. First up is Reddit, ticker RDDT, a platform that's become a household name, yet is often overlooked by investors searching for the next big thing in tech. While most people know Reddit as the place for viral memes, breaking news, and endless rabbit holes, few recognize its potential as a serious long-term investment opportunity. Unlike other social media giants that focus on curated feeds and influencer culture, Reddit is fundamentally different. It's built around authentic, user-driven communities, subreddits, covering every interest imaginable, from personal finance and science to gaming, gardening, and even the most obscure hobbies you can think of. Each subreddit is a microcosm, with its own culture, rules, and dedicated user base. This unique structure creates deep engagement and loyalty. For millions, Reddit isn't just a website, it's a daily ritual, a place to learn, share, debate, and connect with like-minded people. The platform's open, discussion-based format encourages genuine interaction, making it stickier than most social apps. For years, Reddit barely monetized, prioritizing user experience and organic growth over profits. But with its recent IPO, the company is entering a new era. Now, there's a clear focus on building sustainable revenue streams and scaling the business, all while trying to preserve the authenticity that made Reddit special in the first place. One of the biggest changes is the rollout of advanced advertising tools. Brands can now target highly specific, passionate audiences. Imagine advertising coffee gear directly to R Coffee, or gaming accessories to R Gaming. This level of targeting is a goldmine for advertisers, and Reddit's engaged communities mean ads are more likely to resonate and convert. But the real game changer for Reddit's business model is data licensing. In the age of artificial intelligence, Reddit's vast archive of over a decade of human conversations is incredibly valuable. These real, nuanced discussions are perfect for training language models, making Reddit's data a sought-after resource for tech giants and AI startups alike. Their recent $60 million deal with Google is just the beginning. As the demand for high-quality, human-generated data grows, especially with the rapid advancement of AI, this high-margin revenue stream could become a major pillar of Reddit's business. Expect more deals and partnerships in the future as companies race to access Reddit's unique dataset. What truly sets Reddit apart is its structure. Text-based, topic-focused, and community-moderated, this model is nearly impossible to replicate at scale. The network effect is strong. The more people join and contribute, the more valuable each community becomes, creating a powerful moat that protects Reddit from would-be competitors. Of course, there are risks. Content moderation is a constant challenge, and Reddit relies heavily on volunteer moderators to keep communities healthy and civil. This decentralized approach can lead to inconsistencies, but it's also part of what makes Reddit resilient and adaptable. The company's leadership has navigated these issues for years, balancing free expression with responsible oversight. As the internet shifts away from broad, one-size-fits-all platforms toward niche, community-driven spaces, Reddit's position only strengthens. People crave connection and belonging, and Reddit delivers that at scale, with a platform that's both flexible and robust. The stock isn't cheap by traditional metrics, but you're not buying Reddit for quick profits. You're investing in a platform with massive long-term growth potential, one that's just beginning to tap into its monetization levers. Think of Reddit as Facebook a decade ago, an enormous, passionate user base, just starting to figure out how to turn engagement into revenue. The runway for growth is long, and the opportunities are only expanding as digital communities become more central to our lives. There will be volatility, no doubt. The path to profitability won't be smooth, and the company will face challenges as it scales. But the long-term thesis is clear. Reddit is evolving into core internet infrastructure, a foundational layer for online conversation and culture. Its combination of deeply engaged users, early-stage advertising, and explosive AI data potential makes Reddit a unique asset in the tech landscape. Few companies have this blend of community data and growth runway. If you want to bet on the future of online communities and the rising value of human-generated data in a world dominated by AI, Reddit is it. It's a play on both the evolution of the internet and the next wave of artificial intelligence. Spend some time on the platform, explore the depth of conversations, and you'll quickly see why Reddit stands apart. The engagement is real, the communities are vibrant, and the potential is enormous. That's why Reddit is my first pick for a tech stock to buy and hold. It's not just another social app, it's a digital town square, a knowledge hub, and a data goldmine all rolled into one. It's a high-growth story with multiple levers, advertising, data, and community, and a moat built on authenticity, trust, and the power of real human connection. If you're looking for a tech stock with staying power, Reddit deserves a spot on your watch list. Next up is Oracle, ticker symbol ORCL, a company that's been a pillar of the technology world for decades. While many think of Oracle as an old-school database giant, the reality is that it's quietly undergone a massive transformation, emerging as a true powerhouse in cloud computing and enterprise software. Oracle's journey is a masterclass in adapting to change, and its story is far from over. Back in the 1990s and early 2000s, Oracle was the undisputed king of on-premise databases. Their software powered the backbone of the world's largest corporations, governments, and financial institutions. But as the tech landscape shifted and cloud computing began to take over, Oracle faced a real existential threat. Many predicted the company would fade into irrelevance, unable to keep up with the likes of Amazon, Microsoft, and Google. Instead of giving up, Oracle doubled down. They invested billions of dollars to build Oracle Cloud Infrastructure, or OCI, from the ground up. Unlike some competitors, Oracle focused on high-performance, mission-critical workloads. Think massive databases, complex financial systems, and applications that simply can't afford to go down. Their strategy was clear: migrate their huge base of existing customers to the cloud, offering seamless integration, robust security, and the reliability that enterprises demand. And it's paying off. Oracle's cloud business is now one of the fastest growing in the industry. They're winning major contracts, including high-profile deals with companies like TikTok, and their cloud revenue growth is accelerating quarter after quarter. This isn't just a catch-up story. Oracle is carving out a unique niche, especially among customers who need both performance and security at scale. But the real engine behind Oracle's success is its enterprise software, particularly its Fusion and NetSuite ERP platforms. These aren't just tools. They're the digital nervous system for thousands of organizations, running everything from HR and payroll to supply chain management and financial reporting. Once a company is plugged into Oracle's ecosystem, switching costs are enormous, making these products incredibly sticky. This stickiness translates into recurring, high-margin revenue streams that provide Oracle with a stable, financial foundation. In fact, a huge portion of Oracle's revenue is now subscription-based, giving the company predictability and resilience even during economic downturns. This is the kind of business model that investors dream about: steady, reliable, and highly profitable. And Oracle isn't standing still. They're embedding artificial intelligence directly into their core products, making them smarter and more efficient. Imagine having AI-driven insights and automation built right into your financial systems, HR tools, or supply chain software. No need for bolt-on solutions or third-party integrations. This makes Oracle's offerings even more indispensable to their customers, and it's a major differentiator in a crowded market. One of Oracle's boldest moves was its acquisition of Cerner, a leader in electronic health records. Healthcare is a sector that's been notoriously slow to modernize, but it's also one of the largest and most critical industries in the world. By bringing Cerner into the fold, Oracle now has a massive foothold in healthcare IT, with the potential to revolutionize how patient data is managed, shared, and secured. If Oracle can successfully integrate Cerner and bring its cloud and AI capabilities to healthcare, the growth potential is enormous. This could be a game changer, not just for Oracle, but for the entire healthcare industry. It's a long-term play, but one with the potential to deliver significant rewards for patient outcomes and investors alike. Financially, Oracle is a machine. The company generates strong profits and throws off tons of free cash flow every year. They return a lot of this cash to shareholders through regular dividends and aggressive stock buybacks, which help boost earnings per share and support the stock price. This disciplined approach to capital allocation is a big reason why Oracle has remained a favorite among long-term investors. Despite its impressive transformation and growth, Oracle's stock still trades at a reasonable valuation. For a company with both growth potential and stability, that's a rare combination. It's not the cheapest stock out there, but when you factor in its recurring revenue, strong balance sheet, and shareholder-friendly policies, Oracle looks like a compelling value. Of course, there are risks. The cloud market is fiercely competitive, with giants like Amazon, Microsoft, and Google all fighting for market share. Integrating Cerner is also a massive undertaking, and there's always the possibility of execution missteps or cultural clashes. But Oracle has faced big challenges before and come out stronger on the other side. Much of Oracle's resilience comes from its leadership, especially co-founder Larry Ellison. He's known for his bold vision and willingness to make big bets when others hesitate. Under his guidance, Oracle has repeatedly reinvented itself, proving that it can adapt and thrive in a rapidly changing tech landscape. Oracle isn't the kind of stock that's going to double overnight. It's not a flashy, high-flying 10-bagger, but what it is a classic compounder, a company you can buy, hold, and watch as the combination of growth, cash flow, and shareholder returns steadily build wealth over time. This is the kind of stock that rewards patience and discipline. For investors who want exposure to the growth of cloud computing and artificial intelligence, but with less risk than pure growth plays, Oracle is a fantastic choice. It offers a unique blend of innovation, stability, and financial strength that's hard to find elsewhere in the tech sector. Oracle's software and infrastructure are deeply embedded in the global economy. From multinational corporations to hospitals and government agencies, Oracle's technology is everywhere, quietly powering the systems we all rely on every day. That kind of reach and integration is incredibly difficult to displace. That's why Oracle is my second pick, a story of transformation, resilience, and relentless execution. It's a company that's proven it can weather storms, adapt to new realities, and come out stronger on the other side. The market is still catching up to the new Oracle. As more investors recognize the company's transformation and growth potential, long-term holders could be very well rewarded. This is a stock that deserves a closer look, especially for those building a future-proof portfolio. If you want to learn how to spot undervalued stocks like Oracle, companies with strong fundamentals, durable business models, and real growth potential, check out my Value Stocks Investing Master Course. The link is in the description below. Oracle is a foundational tech holding that brings both growth and stability to any portfolio. It's the kind of stock that can anchor your tech allocation, providing a solid base while still offering upside from innovation and market expansion. Remember, investing isn't about chasing the latest hype or jumping on every trend. It's about finding proven, durable business models that can deliver results year after year. Oracle fits that bill perfectly. Looking ahead to the next decade, Oracle is a name you'll want in your tech portfolio. Its combination of innovation, stability, and global reach makes it a must-own for anyone serious about long-term investing. That's why Oracle is my second must-own tech stock, a company that's proven it can adapt, execute, and deliver for shareholders year after year. Finally, let's talk about Netflix, ticker symbol NFLX, the company that not only defined the streaming era but continues to set the pace for the entire industry. From its humble beginnings as a DVD by mail service, Netflix has transformed itself into a global powerhouse, fundamentally changing how the world consumes entertainment. Today, it stands as a symbol of innovation, adaptability, and relentless ambition in the digital age. Netflix's greatest advantage is its sheer scale. With over 260 million subscribers spread across nearly every country, Netflix has built a massive global audience. This scale creates a powerful flywheel effect. More subscribers mean more revenue, which allows Netflix to invest heavily in original content, which in turn attracts even more subscribers. It's a virtuous cycle that competitors struggle to match, and it's the engine behind Netflix's continued dominance. Despite the rise of formidable rivals like Disney+, Amazon Prime Video, and Apple TV+, Netflix remains the default streaming choice for millions worldwide. Its intuitive interface, vast content library, and global reach make it the go-to platform for both casual viewers and binge-watchers alike. In many households, Netflix is synonymous with streaming itself, a testament to the brand's cultural impact. In recent years, Netflix has shifted its strategy from growth at all costs to a focus on sustainable, profitable growth. The company has taken bold steps to crack down on password sharing, ensuring that more viewers become paying subscribers. At the same time, Netflix introduced an ad-supported tier, opening the door to a new segment of price-sensitive customers and creating a fresh revenue stream that didn't exist before. These strategic moves are already paying off. Netflix's revenue and profit margins are on the rise, and the ad-supported business is quickly gaining traction. Analysts believe that advertising could become a major profit driver for Netflix in the years ahead, potentially rivaling its subscription business in importance. This diversification makes Netflix's business model more resilient and positions it for long-term success. What truly sets Netflix apart is its data-driven approach to content creation. The company leverages vast amounts of viewer data to understand what audiences want, not just in the US, but in every market it serves. This allows Netflix to produce global hits like Squid Game, The Crown, and Stranger Things, shows that resonate with diverse audiences and become cultural phenomena. Their ability to predict and deliver on audience preferences is unmatched in the industry. Netflix's investment in global production hubs is another key advantage. By building studios and partnerships in countries around the world, Netflix can create authentic local content that often breaks out to become international sensations. This strategy not only broadens its appeal, but also helps the company manage costs and tap into new creative talent, enriching its content library with fresh perspectives and stories. But Netflix isn't stopping at movies and TV shows. The company is expanding into live events, such as comedy specials and sports, as well as interactive content and mobile gaming. These new ventures are designed to deepen user engagement, increase the value of a Netflix subscription, and keep the platform relevant as entertainment habits evolve. By diversifying its offerings, Netflix is positioning itself as a one-stop shop for digital entertainment. Financially, Netflix has reached a new level of maturity. The company is now generating significant free cash flow, a major milestone for any growth company. With expanding margins and a robust balance sheet, Netflix has begun aggressive stock buybacks, returning value directly to shareholders. This financial strength gives Netflix the flexibility to invest in new content, technology, and markets, while also rewarding investors. Of course, there are risks. The streaming landscape is more competitive than ever, with deep-pocketed rivals constantly vying for market share. A few quarters of lackluster content could lead to subscriber losses or slower growth. Additionally, shifting consumer preferences and economic downturns could impact spending on entertainment. Yet, Netflix's brand recognition, global scale, and relentless content engine give it a durable competitive advantage. The company's ability to adapt quickly to market changes and innovate ahead of the curve has allowed it to weather challenges that have tripped up others in the industry. In times of economic uncertainty, Netflix's affordable ad-supported tier provides a compelling value proposition, helping to retain subscribers who might otherwise cancel. This makes Netflix more resilient than many of its competitors who rely on higher-priced bundles or less flexible offerings. The streaming wars have been fierce, but as the dust settles, Netflix has emerged as the clear leader. Its combination of scale, innovation, and brand loyalty is unmatched, and it continues to set the standard for what a modern media company can achieve. The market is beginning to recognize Netflix's strengths, but there's still significant upside. The full potential of its advertising business, international expansion, and new content formats is not yet fully reflected in the stock price. For investors, this represents a unique opportunity. Investing in Netflix is a bet that streaming will remain the dominant form of entertainment for years to come, and that Netflix will continue to lead the way. As the company explores new technologies, storytelling formats, and business models, it's poised to capture even more value from the global shift to digital media. Netflix isn't just a tech company or a content studio, it's a global media empire, shaping culture and conversation on a massive scale. Its influence extends far beyond entertainment, impacting how stories are told and shared around the world. Time and again, Netflix has proven its ability to adapt, innovate, and lead. Whether it's pioneering streaming, investing in original content, or exploring new business models, Netflix consistently stays ahead of the curve. For long-term investors, Netflix offers a rare combination of growth, profitability, and industry dominance. Its track record of execution and vision makes it a compelling choice for anyone looking to invest in the future of media. Netflix is a cornerstone of the modern media landscape, and a cornerstone for any growth-focused investment portfolio. Its continued evolution ensures it will remain relevant and valuable for years to come. That's why Netflix is my third and final pick for investors seeking exposure to the future of entertainment and digital media. If you want to own a piece of the future, Netflix is the stock to watch and the stock to own. So, there you have it. Reddit, Oracle, and Netflix, 3 tech stocks with real staying power and long-term growth potential. Each has a strong moat, a clear growth path, and a business model built to last. Building wealth isn't about chasing fads, it's about holding great businesses for the long haul. Which of these 3 are you most bullish on for the next decade? Let me know in the comments. Don't forget to like, subscribe, and join our community for more in-depth analysis and exclusive stock tips. Thanks for watching. See you in the next one.